Welcome to the Deep Dive. Today, we're zeroing in on Netflix stock, NFLX for those watching tickers.
Right.
We've basically combed through the latest stock reports, insights from their recent earnings calls, some news items, all to bring you a really focused analysis.
Mm-hmm.
Our mission. Simple, give you the key info you need on where Netflix stands now and, its potential future, all in under 15 minutes. Sound good?
Sounds great. Let's jump in.
Okay, so where are they sitting right now, stock-wise?
All right, so get this. The last close was $196.87. That was up 4.50% in just one day. Pretty strong move.
Wow, okay, and the range over the year?
Yeah, the 52-week range is pretty wide. It's gone from about $544 all the way up to $1,101 worse.
So volatility is there.
And it's a giant, right? Market cap.
Oh, absolutely massive. Market cap is hovering around $469 billion, and the enterprise value, which includes debt, is slightly higher, but $477 billion TTM.
So a true heavyweight. Now, valuation. I saw a fair value estimate around $967. How does that stack up to the current price? Yeah, that estimate was $967.22. And as of mid-April, analysts had the market price pegged near $973 too. So very close.
Which leads to that neutral rating we saw.
Okay.
Basically saying it's trading about where it should be.
Exactly. The neutral suggests the market price isn't far off from what analysts think its intrinsic value is, at this moment.
Okay. Let's talk about their edge, their economic moat. It's rated as narrow. Can you unpack that for us quickly?
Sure. So think of a moat like a castle's defense against invaders, but for profits against competitors.
Right.
Netflix's is narrow. Why? Well, they have a super strong brand, massive subscriber base, huge advantages.
Fun.
But the content library itself isn't uniquely defensible. I mean, Disney, Amazon, everyone else is making great stuff too. So others can compete effectively with content.
So that narrow moat means they constantly have to spend on new shows, new movies, innovate with things like ads.
Precisely. They have to keep investing heavily in content people must see, and things like advertising, interactive stuff. They need that to stay ahead. Investors really need to watch their execution on that front.
Makes sense. The streaming landscape is definitely crowded. Okay, switching gears, slightly recent earnings, Q1 2025, sounded positive.
Yeah, overall positive. They actually beat expectations on operating income for Q1, mostly due to some expenses shifting around, favorable timing.
Ah, okay. So not necessarily a fundamental shift for the whole year.
Right. Management was careful to say, don't get carried away. This hasn't changed the full year guidance, but the Q2 guidance was upbeat.
What are they expecting in Q2?
They're looking for revenue growth in the U.S. and Canada to reaccelerate.
Yeah.
That's driven by recent price hikes kicking in and, importantly, more advertising revenue.
Right, the ads. And content is obviously still central to all this.
Oh, absolutely fundamental. They flagged plans to actually increase content spending in the back half of 2025, aiming for a stronger slate, which also helps boost ad sales.
Interesting. And they're also pushing into live events more, aren't they? The NFL game boxing.
Yes. That's a really key strategic move. The NFL Christmas Day game was seen as a success. They have that Taylor Serrano boxing match coming up. It's about diversifying, finding new revenue streams beyond just, binging shows on demand.
Smart. And AI is part of the picture, too.
It is, yeah. They're using it behind the scenes, trying to make content creation more efficient, but also, importantly, improving discovery, better recommendations to keep you watching, keep you subscribed, reduce that churn.
Okay. And the advertising business itself, how's that progressing?
Seems to be moving fast. They're talking about potentially doubling ad revenue in 2025.
Doubling?
Yeah. And they said their own ad tech platform rollout went better than expected. Now, they admit it's still early days for super sophisticated ad targeting, but the growth trajectory looks pretty strong.
So financially, they seem pretty solid then.
Very much so. They're projecting a really robust $8 billion in free cash flow for 2025.
And just quickly, free cash flow is basically the cash left over after running the business and investing.
Exactly. Cash they can use to reinvest, maybe buy back stock, pay down debt, just keep a strong balance sheet. It underpins those ambitious long-term goals they have, like doubling revenue, tripling operating income by 2030, though hitting those targets is obviously a big ask.
Sure, aspirational but backed by cash flow. What about risks? What could derail things?
Well, the big one is always the macro environment. Economic downturns hit consumer spending, which could mean subscription slowdowns or cancellations.
Makes sense. Anything else?
There are always international risks, different taxes, levies in various countries. But their strategy of producing content globally actually helps mitigate some of that, creates local presence.
Okay. What are the analysts saying overall? What's the street view?
The average price target from analysts, looking back about 6 months, is around $1,111.97. So generally bullish compared to the current price, even after the recent run-up.
Any specific example?
Yeah, we've seen several recent upgrades or high targets. Evercore ISI raised theirs to $1,150. Guggenheim, also 1,150s. Moffett-Nathanson, $1,150. FBN Securities just initiated coverage at Outperform with $1,165.
Mostly positive signals there.
Mostly, yes. But, not universally. Loop Capital, for instance, pointed out some data suggesting user engagement might have dipped recently, so there are still some watchful eyes out there.
Always good to have the counterpoint. Okay, just to throw out a few key financial figures quickly. Trailing 12-month revenue, about $40 billion.
$40.14 billion, yeah. Net income, $9.27 billion.
Forward EPS around $25.46, giving a forward PE of about 43.
That's right, 43.07. And price to sales forward is about 10.55. Free cash flow TTM was $7.45 billion, supporting that $8 billion projection for 25.
And analysts expect those revenue and EPS numbers to keep climbing over the next few years.
Yes, the projections generally show continued growth, assuming they execute on their strategy.
Okay, so let's try and wrap this up in our target time. Key takeaways seem to be Netflix is showing real operational strength. Q1 was solid. Q2 forecast looks good.
Driven by content, the new push into live events, and that rapidly growing ad business.
Right. But risks remain. Competition is fierce. The economy is always a factor. Still, their financial health looks strong, and their strategies, well, they offer interesting possibilities.
Definitely.
So maybe the big question for you listening is this. How effectively can Netflix keep churning out must-watch content while simultaneously scaling up these newer areas like live events and advertising to really drive that profit growth long-term? That balance seems key.
Absolutely. That's the dynamic to watch going forward.
For sure. So if you found this quick deep dive valuable and you want more focused analysis like this on companies and trends, please do subscribe to the channel.
Yeah.
And definitely hit that bell icon.
Yep, helps us keep bringing these to you.
It really does. Thanks so much for tuning in.